To quote Vinod Khosla, you want to invest in $0 billion companies. If a company can't be worth at least $1 billion, you don't want to invest. If you can't make at least 100x return, you're not seed investing anymore. You're Series A investing, but you're doing it with less capital and less ownership. At the seed stage, something in your portfolio has to get to the 100x mark for your portfolio to start making sense, assuming that you have a relatively diversified portfolio. You should not invest in companies that look like they're interesting and will return 5 to 10x. Why? A lot of them are going to go to zero. Only a few will go 5 to 10x. And so it barely makes up for your losses. Secondly, you don't have enough capital at stake. A venture capitalist can put in millions of dollars per deal. So to them, a 10x return or a 5x return on a winner is very meaningful, and a 3x is meaningful. But as a seed investor, you have to go for broke. Your ownership is so small that it will not make a material difference on your life or for your investors unless the company is a massive outsized success. The venture capitalists themselves are not going to invest in things that attack small markets. VC funds are quite large. They need to generate hundreds of millions of dollars in return on a winning investment to justify the fund. So VCs will not invest in companies that are not going to be big enough. Many of the top VCs will pass on companies that are only going to get to $1 billion in market cap. Even that may be too small. Everybody's looking for the grand slams in this business, not just the home runs, as Bill Gurley likes to say. This doesn't mean you only go after things that have obviously large markets. When a market is emerging, it'll by definition look smaller.